Hello, this is Jed Brewer with Study Groups and the Below the Line Club. Very nice to have you on our webinar today as we talk about mergers and acquisitions and also talk about a legal update. A lot is changing in the industry. Interest rates are up higher than where they were a year ago. There's been talk about, hey, will interest rates come down? I'm not really sure where interest rates will go, but what we do know is the landscape overall is changing. And so it's always nice to get an update from people who know more than I do about it, which Matrix Capital Markets Group. So we'll have two people presenting on the M&A update, and then also Jim Dierking, who's over at an attorney at Winthrop Weinstine. So Spencer is co-head of Downstream Energy and Convenience Retail and Investment Banking at Matrix. And then Sean Dooley is the managing director at Matrix. And Matrix works with a number of study group members and other firms in the petroleum convenience sector, as well as other industries too, but providing mergers and acquisition and financing activities. So Spencer and Sean have a good pulse on the industry of what they're hearing out there on deals they're working on and other deals to give us an update on M&A activity. And they're going to focus a little bit on both the retail and fuels M&A update, also propane, and also lubricants today. And then we'll follow that with a brief legal update from Jim Dierking, again, an attorney at Winthrop Weinstine. Winthrop Weinstine provides a number of M&A law services, but also across a variety of other law needs that are out there. They're based in Minneapolis, Minnesota area. Jim's been involved in the industry for a number of years and has a book of business in the petroleum convenience area as well. So Jim will be talking a little bit about Corporate Transparency Act and compliance around it, the joint employer rule, an update to what's going on there, and then also non-compete agreements, providing an update with agreements in that vein. So should be really educational. That's our heart and our hope on this call today. We want to get your questions answered. If you do have a question, as anybody is talking, I have you on mute, but please type that question to the GoToWebinar framework, the dialog box there. I can see that question. I'll be able to read it, and I'll relay it as best as I can to our presenters in an appropriate time so we can get those questions answered and make this educational for everybody on the call. So with that introduction, Spencer, I'm going to turn the floor over to you at Matrix Capital Markets Group and tell us what's going on in the M&A market so we need to be aware of.
Well, thank you very much. We're flattered to be back again this year. We've been doing this for several years, and luckily, this is the core of the industry right here that's represented by you guys, Jed, so thank you for having us back again. And joining me this year is my colleague, Sean Dooley, who's going to be helping me out. And then, of course, everybody remembers Jim Dierking from how many years now, Jim, you've been doing this?
I think it's about 4 or 5, yeah. Something like that.
Yeah.
It's been a great pleasure.
Yeah, so we're going to start with, we're going to look back at 2023 activity, and then we're going to kind of break it down into the subdivisions of retail and wholesale fuels, propane and lubes, and then we'll have the legal update. And we look forward to answering any questions as we go because we'd like to get those, so please ask any questions. But first, we're going to try to set a perspective, and we're going to talk about M&A overall for all sectors of North America, not just our industry. And you can see that there was a lot of press about M&A being down since its peak in 2021, which was a really high volume year for many industries, almost every industry really. And it peaked, if you can see the yellow line here, that's the deal count. And then the blue lines are deal value. And you can see in the fourth quarter of 2021, and the second quarter of 2021, we had a lot of activity, but the whole year was very active. And then we had a decrease in 2022 across all sectors. And then of course in 2023, it kind of was still kind of flat with a little more activity in the fourth quarter. So, on a quarterly average basis, between the quarterly average for 2021 and 2023, we're down about, on a quarterly basis, about 20% from that 2021 peak. Now, and that's across all sectors. And on a total deal count basis from 2021 to 2023, down about 25%, just on the absolute basis. So What are the reasons? Everything you guys read about in the Wall Street Journal or see on TV. After such a high volume year in 2021 and really low cost of capital, we had a disconnect between buyer and seller valuation expectations. Obviously higher financing costs that Jed mentioned earlier. Credit tightened. We had some bank failures and banks looking for deposits, and that tightened credit a little bit, and just a little bit of uncertainty on changing economic conditions. So that's a snapshot of every sector beyond, our industry. And this slide here will drill down a little bit. It drills down to the major sectors, and this is data provided by PitchBook. And you can see this is really the same data we have in terms of deal count on the slide before. But the major sectors that were down that drove the decrease was healthcare, information technology, and materials and resources. Those are really the laggers that we had across the industries. And, energy was down a little bit as well, but we had some more activity, and we're going to get to that in a little bit. And of course, financial services, everything was down as reported by PitchBook. So what does that mean for our industry? And I think you're going to be surprised that when you see a lot of media reporting and people talking in the press, it seems to be kind of an echo chamber. But if you look underneath the covers a little bit, the data is a little bit surprising. We actually did very well in our industry. So let's look at it from first, how does Matrix define downstream energy and convenience retail? Every box on this page represents what our group covers in terms of M&A transactions, valuation, and capital raising. So you got petroleum marketing and distribution, which is fuels distribution, convenience retailing, propane, lubricants, terminals, heating oil, and petroleum transport and logistics. That's what we do our work in. But what we want to compare right now is what was the activity in the blue box, and that's petroleum marketing and distribution and convenience retail. And the reason why is that we can compare this is that there are more public companies and more data available for these two industries of the sector we cover versus the other ones. We have some good information on the other ones, but we have a lot of public companies that are wholesale distributors and convenience retailing, and that allows us to do a good comparison without using confidential information from our transactions. We can show the trends. So let's look first. We're going to talk about deal counts, we're going to talk about multiples, and then we'll talk about valuations. So on this slide right here, this is our tracking of transactions. And we track, including in here, you have to have a transaction that has at least 10 convenience stores or 25 supply accounts or 2 truck stops in the US. Convenience stores and fuels distribution businesses have to be a substantial component of the transaction. We don't include transactions like capital raising transactions such as sale leasebacks. They're not included in this data. So this is M&A counts, and it's all deals, not more than just Matrix deals. It's all deals that we can find that have been reported and consummated. So if you look at the bottom of the bottom table, you'll see the column for 2021. That was the peak, and we did 59 deals in the industry for these two segments of the industry. And you'll see in the Q4 we did 34, and a lot of those deals were done in that Q4. As you remember, there was a lot of concern about an increase in the federal income tax rates and capital gains rates, et cetera. So a lot of deals that may have been done in 22 were actually pulled into the end of 2021. Then we had a decrease. If you look next to the 59, we went down to 31 in 2022, but then back up in 2023. So as compared to the data that you saw on the pages before for all of the sectors or all the sectors of the economy, from 2022 to 2023, all the sectors were down, but we're actually up on a deal count basis by 35%, from 31 to 42. If you look at the average number of transactions that we track in this industry from 2014 to 2023, the average has been 37 transactions a year. We did 42 in 2023, which is about 13.5% more than the average. And of course, in 2022, we were down a little bit, about 16%. So really, it's a little bit different than what you hear in the press. I mean, we were hearing early this year, things are down, counts are down. We were not seeing that at Matrix. So we decided we're going to track all this again, and we're going to report on it. And so that's obviously what we're doing. So I think this is very positive that our industry has remained extremely active. So now,
Spencer, real quick clarification on that total. Those are the deals that Matrix Capital Markets Group has done, correct? Not necessarily total.
No, that's all.
Inconvenience.
No, and we track every one that meets this criteria. Unfortunately, we did not do 42 in 2023. I wish we had. We did a good bit of those, but we didn't do all 42. I would like to say we did, Jeb, but we didn't. So no, we track.
Got it. Yeah.
We track the whole industry as best we can that meet that criteria. And sometimes there's a deal sometimes there's a deal, Jeb, that doesn't get reported, but we usually find out about it somehow or the other. So that's everybody. So then we get the questions about multiples. We hear it, are multiples down? Multiples have to be down. So on this slide here, this is an interesting slide. The blue line, graph line, that's the enterprise value, the corporate EBITDA for the publicly traded companies in our index. So our index being anyone who's publicly traded, okay, in our industry. And you can see the footnote below includes companies like Global and Circle K, Casey's, all those. We put them all in an index and we look at their forward enterprise value weighted multiple, and we track that. And so the green line are transaction multiples, which is a little bit different for all sectors. And the orange line, orangish line is just energy, what we got from the energy data that we collected. But more importantly, what people are interested in is, it's interesting to do a relative comparison, but if you just look at the blue line, 2021, the multiple for the publicly traded companies, enterprise value divided by corporate EBITDA, was 9.9 times. That was the median. It did decrease to 9.6 in 2022, and then it went back up at the end of 2023. So where all sectors in 2021, after 21, went down about 1.7 times on an EBITDA multiple, we declined much less. We could decline whatever 9.6 divided by 9.9 is. That's how much we declined, which was not as much. But we declined a little bit, these public companies did. But as we went through 2023, what happened was, I think the analysts and people that do forward, these forward multiples, and the multiple, and then that reflects on the trading of the public companies. They started to say, look, I think this cash flow that these public companies are generating is a lot more recurring and stable than we realized. And so that meant the market capitalization started to respond, and that leads to a higher enterprise value. So it's a very interesting thing. It slipped some in 2022, but really came back in 2023. And of course, these are publicly traded multiples. A lot of times in a transaction, they'll be even higher because of a control premium, but those are the multiples that we are seeing from the publicly traded companies. So multiples, they did go down some, but they have come back. And I think that's good for the industry. So the last question we typically get is, well, values have gone down, right? And, it depends on the quality of your company. It's a hard question to answer universally. But if we go by, again, the publicly traded companies, and you look back at the enterprise value, and we go back to 2007, we have an index for that as well. And there's some companies that come in and come out, and we adjust for that. So for example, Arco went public in 2019. They had a little bit of effect on this, on these bars. Like, we're just not adding because we have new public companies, but you have other companies that kind of left and were tucked underneath other companies, like the Pantry and CST brands. But you can see while the multiples have fluctuated, values have continued to rise. And part of it is that your multiple can stay the same if you're generating more EBITDA, your value is going to go up. But now the multiples are rising even more, enterprise value is going to go up even further. So we have not seen a lot of degradation of enterprise value. And I can't show you our data on deals we've completed, but it's been strong and hasn't been crazy. We had a couple of deals in 2021 that were very, very strong, but those were extremely high quality companies. But if you look back and having done this since the late 90s, our market, for our companies has been really good. So, Jed, I think there's a number of reasons for that, and you may want to offer some, but to me, I think the industry is strong because obviously it's getting great margins. The margins have been rising for a number of years, fuel margins especially, but EBITDA has been also, that's the most important thing, that's been rising. And I think that these leading consolidators or people who have grown within their own regions, the synergies and the things that they can do have just, outperformed or exceeded the rise in cost of operating costs. So, they're comfortable that they can drop a lot more cash flow down to the bottom line. And then the size gives them even more power to go out and build more or buy more and, and then work with their vendors to have the best, procurement they can get. So the interest rates have not really thwarted them as much as we expected it to be.
Spencer, it's interesting because you go back to 2019 and margins were just at a different level, like you noted, than what they've been in recent years. And a lot of concern has been, well, am I going to get paid on these higher margins, or are we going to normalize this back to something else? What is normal is kind of a bigger question. But what you see in the multiples from the data that you show is they've held up even in more recent years on that higher EBITDA level that is present because of higher margins. So I find that interesting. One member asked, what about regional variance? Do like say the East Coast get higher margins or multiples than West Coast, or are they kind of the same that you see across the firms you analyze?
I really appreciate whoever asked that question because we get questioned. We'll be at a conference like you and I were at Sigma last year, and people are like, "What's the multiples?" I hear the multiples of this. I mean, it's a hard question to answer. It varies by where you are in the country. It varies about real estate control, lease versus fee. It varies about your channel of trades, how quality of your assets. There's a lot, rebates. I mean, synergies that somebody can get if they buy it. So when we do an intrinsic valuation, when we're trying to look at it from the lens of a potential buyer, and a 7-Eleven may look at it differently than a large regional, what they can do, with their business model with that company. So we factor those things in, and we try to provide a range because offers, you have to be honest with people, right? You got to say, look, we expect the offers to come in this range. If you do sell, we always want to get higher and get the best on a deal that can close. But people need to be prepared that it's just not a simple linear formula, right? And you're going to get, if you do get a valuation or even go to market, you're going to get a pretty decent range of offers based on how certain buyers look at things and where you are in the country. So
that makes a lot of sense.
Yep. So that was. I'm going to turn now. I know I got to go with a little bit of pace here. I'm going to turn it over to Sean, who's going to talk about propane.
Thank you, Spencer. So Spencer covered all sector M&A and then retail and wholesale fuels industry M&A, which is inclusive of convenience retailing. The next 3 slides I'm going to cover deal with propane distribution or the propane industry. And we have that signified in the blue dash box, so you know that we're specifically talking about the propane industry. On this side, this is how we break out the competitive landscape of the propane industry in terms of operators or companies. you have the top three, Suburban, AmeriGas, Ferrellgas. We characterize them as having a national reach or presence. They're all publicly traded, and they have about 20% of the market share by volume or gallons. Below that, you have the large regionals, number of companies. Our range is about 35 to 50 large regionals. These are multi-state propane distributors, and they also have about 20% market share. And then below that, you have what we call the local market focused companies. And these are typically single state operators, or maybe they're in two states, with an adjacent state, and about 2,500 companies and 60% market share. So you can see it's still a very fragmented industry, the propane industry, that is, and that is good for M&A in the future, because the national players and then the large regionals will be looking to still acquire the more local market focused players. Next slide. Here, breaking out a little differently, in the top left, we have the U.S. public companies. That's Suburban, Ferrellgas, and UGI, AmeriGas. Those are the three you saw on the previous slide. We also have Star Group and Chesapeake, who are both publicly traded. Star Gas has a significant amount of heating oil. Chesapeake is in the natural gas business, so they're less pure play propane companies, but publicly traded nonetheless. In the bottom left, we have the private equity backed companies, and you can see there's 5 here. They're very active in M&A. Thompson's backed by Redwood Capital. EDP, or Energy Distribution Partners, is backed by Pritzker Capital. Letterman's backed by CID, is a recent platform company. Pop Energy backed by Delos Capital, and Sail Energy backed by Protos Capital. So they've made those private equity funds or financial sponsors have made platform acquisitions in the industry and continue to do M&A. And then on the right-hand side of the slide, you have the co-ops or cooperatives in the top right, the large private regionals, which we referenced a few of those on the previous slide, and then the international companies. DCC is headquartered in Ireland. Superior Plus is headquartered in Canada. And SHV Energy is one of the largest propane distributors in the world, is headquartered in the Netherlands, but they all have U.S. operations as well. Next slide. So this slide will be a similar format to what you saw from Spencer in the retail and wholesale fuels. We have the last 10 years of M&A in the propane industry by quarter here. This includes all publicly announced transactions in North America. The vast majority of these will be based in the U.S. There are some Canadian operations in this M&A table, but vast majority is the U.S. And in order to be included in this table or graph, the propane distribution business had to be the most sizable part of the transaction. So especially in the northeast part of the country, as most people know, in the home heat business, there's a lot of dual fuel companies, meaning heating oil and propane. But in order to make this graph and table, the predominant business had to be propane distribution. So you can see in the second primary bullet, there's been a lot of activity, 133 unique buyers for 478 transactions over 10 years. So that's a lot of transactions and a lot of different buyers. Focusing a bit how Spencer did on 21, 22, and 23, you can see that actually in the propane industry, 2022 was quite a strong year with 72 transactions, which was 10 above 2021. And then in 2023, we slipped down to 54 transactions in the industry. However, that's still above the 10-year average of 48 transactions annually. So roughly 10% above the long-term average last year. So that is encouraging as well. Next slide. Moving from the propane industry to the lubricants industry,
quick
going to touch on.
Where do you see M&A activity going? You say it's still relatively fragmented with 60% in that lower bucket. Do you continue to anticipate there being greater consolidation? And do you anticipate any consolidation up at the top of the pyramid?
Spencer, you mind going back to slide,
Sure.
back 1 or 2 slides? So AmeriGas hasn't been very acquisitive lately. Suburban's been somewhat selective in terms of M&A. Ferrellgas recently started doing more M&A. So the three largest publicly traded propane companies, they have not been the most acquisitive. I would actually say if you drop down to that middle box, Jed, Energy Distribution Partners and Thompson Gas and Superior Plus have probably been the most active acquirers over the last few years. And as you referenced in that bottom box, there's still 60% market share by gallons or volume of more of the mom and pop or, single state businesses. So we certainly expect, more acquisitions of the smaller companies. And if you go forward one slide, Spencer, if you see the bottom left, there's private equity groups. All of their strategies is what we call a roll-up strategy. So they're acquiring smaller, propane distribution businesses, some mixed fuel businesses, but their strategy is to grow through M&A. Similar to motor fuels and convenience retailing, there's not a lot of organic growth in the propane industry. So to really move the needle, especially for the larger companies, you have to do significant M&A, in terms of volume of transactions or larger transactions.
That makes sense. Thanks, Sean.
Sure thing, guys. Moving on from the propane industry to the lubricants industry, we're going to give a little update here as well. Next slide. So here we have the most acquisitive companies in the industry. That being said, lubricants has been a little, I'll say, sleepier in terms of M&A compared to propane and motor fuels. The most active acquirers in the industry is one down on the bottom row, Relodyne, which is backed by American Industrial Partners. That's their financial sponsor. And then Cadence, who's backed by Wellspring Capital Management, LLC. Somewhat ironically, both of these companies, Relodyne and Cadence, have been sold to these financial sponsors or private equity groups within the last 3.5 years. So even the large lubricant consolidators in the industry have been acquired by different financial sponsors. And Petro Choice, we also signify, they were acquired by Kosan, Move is their brand name. They've been doing less M&A post-acquisition, but they're one of the large players in the industry. Next slide, Spencer. There's not a lot of good, similar to the other industries, there's not a lot of financial information or statistics revealed in transactions, unless it's a public company transaction, a public company buying a public company, or a public company doing a material deal where they have to file information with the SEC, and you can dive into that information and calculate EBITDA multiples and whatnot. However, what we see in the industry for lubricants distributors, for kind of small to medium players, call it mid-single digit EBITDA multiples of roughly 5 to 7 times. And then for higher quality, larger distributors where you may have some scarcity value due to the size of the company, that can creep up into the higher single digits, say 7 to 8.5 times. So there is a size premium, as you see in most industries, for larger transaction targets. In the second bullet point here, as I referenced before, Petro Choice was acquired in May 2022, Relodyne was acquired in December 2021, and Cadence was acquired in October 2020. So even the large acquirers have been changing hands in terms of Petro Choice being acquired by a strategic buyer, and then Relodyne and Cadence changed financial sponsors in their acquisitions. It's not these multiples, since it was financial buyers for the most part, were not disclosed, but based upon information we've heard and seen, they traded obviously for a premium of about 8 to 11 times. And they're, as I mentioned before, Relodyne and Cadence are the most active acquirers. But as we see in the other industries we covered as well too, there's also regional operators in the lubricants industry that are doing M&A, closer to home, but they won't jump around anywhere in the country like some of these larger acquirers.
Jed, I think we're finished. We'll take any questions before we hand it over to Jim.
Yeah, one question on propane. So kind of going back to propane, Sean, what are you seeing multiples in that industry ranging at?
A lot depends on, there's different value drivers than Spencer mentioned in wholesale and retail, motor fuels and convenience retailing, but big valuation drivers in propane are tank control. Does the company or distributor own the tank, or does the customer? Typically that highly correlates with automatic versus will call customers, speaking about the residential segment primarily. The more tanks you own, the more customers you have an automatic delivery, and that gets a premium. in terms of an EBITDA multiple. I'd say for the most part, mid to high single digits. Matt, there's different parts of the country on the coast. They tend to get higher margins, not too dissimilar from the motor fuels industry. But tank control, the type of customers you have, the longevity of customer relationships, all those matter. There's not a lot of contracts in the industry unless you get into commercial or municipal. So the way to really control the residential customer is to own the tank at that site, and an acquirer will pay a premium for an automatic, a largely automatic business with tank control versus a will call customer basis that's they're calling around every week to get the lowest price, and there's not a lot of margin there.
Hey, Jed, just to add real quick to that, I mean, that's everything he says I agree with. And, size really matters in propane, really can help the multiple. And, we've been fortunate. We've done a few really large ones, and, you can get into the double digits on multiples, but it takes a special company and sizable and well managed and having the characteristics Sean was just talking about to get that from our experience.
Absolutely. And I know synergies play a big part in what the multiple is going to be. Whose multiple are you talking about? Is it the seller's multiple or is it the buyer's multiple? And deals
Right.
get done when there's a difference between the seller's multiple and the buyer's multiple.
Correct. That's well said.
One question going back to convenience store retailing. One astute member said, boy, since 2014, the EBITDA multiple has declined one turn from 11 to 10 in 2023. And they just asked the question, from a macro level, does electric vehicles play into any of that? And if we see greater electric vehicle penetration going forward, do we anticipate any possible impact on multiples?
Yeah, I don't think that. I think there was in one of those years, and I should know this off the top of my head, there was some, we had the MLPs a couple of the MLPs that had really high multiples. And I think it's an anomaly that's the reason why. But I'm going to get back to you, Jed, because I do have the reason. I just cannot remember off the top of my head. But I don't think it has to do with EV concerns. I really don't.
That makes sense. Yeah, thank you. A couple other questions, just jumping around here, but dealer business. We haven't directly talked about that. We talked about propane, lubricants, and then kind of a convenience wholesale fuels focus. But any information on dealer business?
Okay, is the open dealer business, commission agent, dealer, dealer-owned commission agent, CODO, lease or fee? Which one are you talking about?
Right? That's the hard part.
Yeah, each of those channels of trade we value from the bottom up, because you have to value real estate control and rental income, or the ability maybe to convert back a commission agent to a direct op. You have to look at all this stuff on an open dealer basis. We look at we do a net present value analysis, factoring in, we had to make some assumptions for renewals and things of that nature. And duration of contracts is really important. Credit's really important. So the multiples, when you get down to it and you look at some multiple, the ranges are really wide. So I just would prefer not to, give a range on because there's so many differences in those type of businesses that we've seen.
Yeah, that makes sense. And then heating fuels. What do you think about the future of heating fuels? Broad question.
I mean, that's a good question. We've talked about this, as you know, Jed, since the early 2000s, right? And that it was a dying business, and but the margins are incredible, right? If you do it the right way, and it's a logistics business, right? You have to really understand the logistics to maximize cash flow, and that's a 2 or 3 hour discussion, especially with good operators. It's fun to talk about. But I think for the right business in the right area of the country, heating oil is going to be around for quite some time. And if you can manage to retain those customers and they understand the BTU value of heating oil, and you do a fair education of what heating oil, the benefits of heating oil, I think it's going to be around quite some time. And, it may not be a high growth business, but it could be a good annuity business if you can manage those customers. And, most of these heating oil companies today are dual fuel. And so that helps them, that propane and heating oil. And then a lot of these companies have been very, entrepreneurial. They're building home services companies where they're offering HVAC services, chimney sweeping, plumbing, and they're building enterprises around this platform of companies, of customers, or heating oil customers. So it's a really good opportunity for entrepreneurial people that really want to build out a big platform in home services.
Thank you, Spencer. Yeah, and one last question, then we'll move on to Jim with his legal update. But it felt like for a time there was a challenge for more moderate-sized family businesses to do deals because the multiples were so high that only the big firms were the acquirers out there. At least that was the feeling. I don't know if that's what you saw in the data or not. And multiples have continued to stay high. Have you seen more family business to family business deals get done, or is it still pretty much all driven by the bigger companies?
When you get, we see a lot of activity family to family when you have a transaction that's less than 100 million or $75 million of enterprise value, right? They tend to be very active. When you get over 100, 150 million, the buyer pool shrinks some, right? Because it's not only, not that those companies won't do those deals, but it just the law of large numbers, Jed, seems to make them more nervous about doing a deal of that size. And I always say to people, look, if you want to grow and compete and you're worried about the capital, you can build a special purpose entity and get a capital partner, right? And go after those companies, those bigger companies, and then you can recap out that capital partner down the road. But the answer to your question is once it seems to get over $100 million of enterprise value, Jed, we seem to shrink a little bit on the number of potential buyers. They go to the bigger ones.
That makes a lot of sense. Well, Spencer, Sean, thank you guys so much. If anybody has other questions, feel free to type them in. If we have time, we'll get to them at the end of the call, but otherwise I'll make sure to relay them to Spencer and Sean, and they'll answer them offline for you too. I know everybody's part here is this to be as educational as possible. Jim Dierking, attorney over at Winthrop and Weinstine. Talk with us a little bit about some of the things that are changing from a legal standpoint. I know joint employer rules, there's always updates, non-compete agreements. Jim, dive in.
Thanks, Jed. And thanks, Spencer and Sean. That's always my favorite part of this whole presentation is listening to you guys because there's such great information. So, as Spencer mentioned, I think I'm back for my fourth or fifth time at this presentation, and I'm happy to be invited back this year. In the past, we've covered, various legal issues relating to M&A transactions, financing matters, and a few other general business issues. As Jed noted, this year, today, I'm going to talk about a few business issues that our clients have been focused on recently. And specifically, I want to talk about the Corporate Transparency Act and compliance around that, updates on non-compete agreements, and if we have time, I'll touch briefly on the joint employer rule update. So first, with the Corporate Transparency Act. So this is a new federal law that was enacted last year with an effective date of January 1 of this year. And it is part of the anti-money laundering legislation that has been going on at the federal government level since, well, forever, but even more so since 9/11 and years since then. So this is sort of an extension of that. And this statute requires certain entities that are registered or formed to do business in the U.S. to report beneficial ownership information, basically who owns or controls the company. And that has to be reported to the Financial Crimes Enforcement Network, or FinCEN, which is part of the Treasury Department. So companies that existed before January 1, 2024 have a year to get into compliance to do their report. must report by January 1, 2025. Whereas companies that are formed anytime after January 1 of 2024 must report within 90 days of being organized. So who must report is kind of the starting point, and like lots of things, it starts with a very broad description of who has to report, and then there are a host of exceptions. But the broad rule is that all corporations, limited liability companies, and similar entities must report if they're formed by filing with any state in the U.S. or if they're formed in a foreign country but registered to do business in the U.S. So that's going to capture 99.9% of all corporations and LLCs that are formed in any state in the U.S. It also covers similar entities that are formed under the laws of Indian tribes, by the way. Many partnerships, limited partnerships, LLPs, LLLPs, for example, must also report if they're formed by filing org docs with a Secretary of State's office. So some partnerships you file and some partnerships you don't. That's kind of the toggle there. In general partnerships and sole proprietorships, there is no Secretary of State filing, so they may fall outside of the requirements. So again, generally it's pretty broad coverage, which makes sense in light of the anti-money laundering purpose of it. The government wants to cast a wide net. And I'll flow through some of these slides fairly quickly, but you'll have them for reference. There's more detail there than I want to get into today in my talk. So as I mentioned, there are many exceptions. I think there's 23 total exceptions that relate to entities, mostly entities that are already required to report this same beneficial ownership type of information under other existing laws or regulations, and then some that are entities that are deemed not likely to be used for illicit purposes. So cutting to the bottom line, starting broad and throwing in all of the exceptions, the net effect is that in large part, the reporting requirements are going to fall primarily on smaller privately held companies. One thing that people need to remember is a lot of times, including in this industry, folks will set up an SPE or just a real estate holding entity to own their real estate and lease it back to their operating companies. A lot of those real estate LLCs, SPEs, are also unlikely to meet an exception, meaning they would have to report. So as you can see here, exempt companies include public companies, banks, credit unions, that type of thing. And the reason there is because they are already required to report this same type of information under other laws. So focusing here on private companies, okay, we're talking about private companies here that are larger and they're therefore likely to be accepted, not have to report. So if you're privately held and you've got more than 20 employees on a full-time basis, and you had gross receipts or sales in excess of $5 million in the previous year, and have a physical presence in the U.S., this is likely to be the exception that you're going to try to fit into so that you may not have to report. A few other exemptions that are not going to have a lot of applicability or fairly obvious, like inactive entities with no active business, no change in ownership in the prior 12 months, no assets, these entities don't have to report. And then also subsidiaries that are wholly owned by an otherwise exempt entity don't have to report. So for those companies that will have to report, the information they're looking for is information with respect to all beneficial owners of the reporting entity. And a beneficial owner is a person who directly or indirectly either owns 25% or more of the ownership interests of the entity, or they exercise substantial control over the entity. So the 25% ownership piece is going to be fairly easy in most cases to determine. It can get a little complex if you start getting ownership spread around among various trusts and those kinds of things, but generally you'll be able to determine pretty quickly who owns 25% or more of the ownership interest of the entity. Where it gets a little more confusing or less clear is the substantial control piece. So anyone that does have substantial control over an entity is also considered to be a beneficial owner. And in determining substantial control, there's kind of a little list of things that the federal government's going to look at. So it would include individuals that serve as a senior officer of the company, typically CEO, president, COO, CFO, that kind of thing. Individuals that have authority to appoint or remove those types of officers or a majority of the board. Individuals directing, determining, or having a substantial influence over important company decisions. So that can be fairly broad. And individuals having any other form of substantial control over the company. So you can see that, this really is drafted with a wide net. It's very broad, and it's focused on control or having the power to control important company matters. And the expectation is that every reporting company is going to identify at least one beneficial owner. Even if your technical equity ownership is spread out so that nobody owns 25% or more, the expectation is there's still going to be at least one person that meets this substantial control test and therefore would be part of the report. So again, a reporting company must identify as a beneficial owner any individual who exerts substantial control. A few exceptions, I guess.
Only one person needs to report, even if multiple people in the company have substantial control. You just need one report.
No, actually, anybody and everybody who exerts substantial control would need to be included as a beneficial owner on the report. What I maybe didn't say very well is that the expectation from the government is that every reporting company will have at least one person who they identify as having substantial control or being a beneficial owner. Minor children, individuals acting as nominees, these are folks who are not considered beneficial owners. If you're acting solely as an employee and your control over the economic benefits are derived solely from employment status, that's not considered to be substantial control. So there's a few different categories where they've laid out folks who are not considered beneficial owners, but this group is much more narrow than the general group of who is considered a beneficial owner. So if you do determine that you are a reporting company, you are not exempt, and you do need to report, and you then identify who are the beneficial owners of this company. And this is the basic information that the government's looking for, and it is pretty basic. It's just full legal name, date of birth, current address, passport number, driver's license, or similar ID number, and then a copy of that identification document. So really, it is just about gathering information about individuals that own and or control companies within the U.S. And, they're building a database for enforcement purposes related to, money laundering, things that are going on. So that's what this is really all about. And the information that gets reported, it's worth noting, is not publicly accessible to anyone, but it is available to federal, state, international law enforcement agencies and financial institutions who are required to do beneficial owner type of customer due diligence. The company that is the reporting company also has to provide basic information about itself. And again, it's very basic. It's the name, address, the state in which it is formed, and then the EIN or the similar tax ID number. So the timing of this whole thing is pretty fresh and pretty current. As I mentioned above, if you are a reporting company and you were in existence before January 1, 2024, you must file by January 1, 2025. if you are formed after January 1, 2024, then you must file within 90 days of being created. There are also situations where you may need to update a report. For example, if the company was previously exempt but no longer at some point qualifies for the exemption, then you have to file a report within 30 days of ceasing to be exempt. And if you discover that any changes to a report are required, or if any information was reported in error, you also must report within 30 days. So, the part of the question is always, what's the penalty for not reporting or not complying? And with this being a new, the statute itself lays out penalties and fines, and they can include criminal fines and prison time for willfully providing false or fraudulent reports, unauthorized disclosure of information, presumably about others, can also lead to heavy civil penalties and criminal penalties. But it is, I think, to be determined as to how this is going to actually be enforced. As with lots of laws that come along with civil and criminal penalties, usually there will be a fairly substantial penalty that's written into the law, and it's kind of an up to sort of thing. And then the actual fines and penalties and prison time, if any, is dealt with on a case-by-case basis. So because it's so fresh and so new, it is hard to determine exactly how that's going to be enforced, but that's something that we'll be watching closely as the year progresses. For the time being, I think it would behoove all companies to, first of all, just sort of determine, are we a reporting company or not? And if so, then we need to start gathering the information that has to be reported about our beneficial owners. So that you'll have to go through that exercise of determining who fits that definition of a beneficial owner. Obviously, then, you need to timely file the report and monitor compliance on an ongoing basis in case, even for those that make a determination that you are exempt, you want to make sure that you stay exempt and are aware of any point in time at which you are no longer exempt so that you can report. So ongoing monitoring is also highly recommended. That's it for the Corporate Transparency Act, and I'll move on in the interest of time here to non-competes for an update, and then we can circle back if we have time at the end with any specific questions, or I can field questions after as well. So non-competes, I'm sure you are all familiar with those in one way or another. Some of you may be aware that in early 2023, the Federal Trade Commission put forth a proposed rule that would treat most non-compete agreements as violations of the Federal Trade Commission Act's prohibition on unfair competition. So to say it another way, the FTC's view in putting this proposed rule out is that most non-competes constitute unfair competition and are therefore invalid. So in announcing the rule, or the proposed rule, the FTC described non-compete agreements as impeding an individual's freedom to change jobs, depriving them of higher wages and better working conditions. Non-compete agreements have otherwise generally been permitted within a variety of limitations, guidelines, state laws, and regulations, although I would say all 50 states have laws that to some degree restrict non-compete agreements themselves. So this is a mix here of federal law and state law. This FTC proposed rule is at the federal level, but state laws are still in force and effect as well. Some states like Minnesota, California, North Dakota, and Oklahoma already ban non-competes entirely. And that's a changing landscape as well, with a few states, including Minnesota, updating their laws just last year. In support of the proposed rule, the FTC noted that non-compete agreements affect 20% of American workers at any given time. They decrease wages, innovation, entrepreneurship, and healthcare affordability. and they're rarely challenged by workers who have really no idea as to their enforceability, which we see all the time. We get questions all the time from people about having signed something at some point along the way during their employment, and they're not sure if it's enforceable or if they can change jobs. I think that's pretty common. The FTC also projected that the effect of the proposed rule would be to increase wages by 250 to 296 billion per year based on the freedom to move. They would lead to one-time compliance costs of 1 to 1.17 billion, and they would close racial pay gaps by 3.6% and gender pay gaps by 9.1%, which is there. So what is the rule? The proposed rule prohibits any clause that prevents a worker from seeking or attempting work from a different employer or operating a related business after ending work for the employer. So it's very broad. There are some exceptions to it, as is always the case, but it's a very broad starting point. The effect of the rule would be to prohibit entering into new agreements or maintaining existing agreements with workers, not just employees. So it would include independent contractors, interns, volunteers, and employees. And from telling workers that they are subject to a non-compete when there's no good faith basis to believe it is enforceable. As I mentioned, it prohibits maintaining existing agreements, which means that those would have to be rescinded. And part of the rule says that in rescinding existing non-competes, the employer must provide written notice so that the employee is fully aware that whatever non-compete they had in place is no longer there. I mentioned that this is a framework of kind of federal law and state law, and the rule specifically provides that it would supersede or take precedence over less restrictive state laws, but not any state laws which may be more restrictive. Some folks that are not covered by this proposed rule, I think most notably would be franchisees. So there are any limitations on competition that are already contained in a franchise agreement, for example, would not be affected by the rule. And then in the context of the sale of a business, persons who own at least 25% of the selling business can be restricted from competing with the buyer for a period of time. So I think, in the context of M&A stuff, that's a pretty critical point in many cases, is that you want to make sure that you're not buying a company from someone and they start a new one tomorrow and take all their business back that you just bought. So the threshold there currently in the proposed rule is 25% ownership or more. And then workers whose non-compete agreements expire before the compliance date under the new rule, those are also not affected. One of the reasons.
What about kind of partnership agreements between two companies? Like, hey, we're going to join together to do this. Part of that agreement is if we stop working together, you're not going to go find somebody else to do this with, and it's going to impair me. Is that covered at all in this non-compete prohibition?
Yeah, it is. Thanks for asking that, Jed. The proposed rule does essentially provide that agreements between or among businesses not to compete with each other are still fine. Those are going to remain valid. They're valid today and they're going to remain valid, so they're not affected by this rule. And there are a few other similar types of agreements that relate to competition and will also still remain valid unless they're drafted in a way that they are functionally just a non-compete. So things like non-disclosure agreements, confidentiality agreements to protect trade secrets or proprietary processes, non-solicitation agreements, which focus on who initiates contact after an employee goes somewhere else, non-recruit agreements, basically against rating the workforce of the employer you just left. So those types of agreements are still going to be valid, again, as long as they aren't just called a non-disclosure, but they really function as a non-compete. So the details of how they're written will still be important.
Got it. And just for the sake of time here, I heard you say, I believe that in an M&A deal, you could still put a non-compete on that business you're buying, whoever the owner is, to not go out and compete with you for a period of time. Is that right?
Yeah, that is right. And I didn't notice the time here either, but I see it's 2 o'clock. So that is correct. So owners who own at least 25% of the company, the selling company, you can put a non-compete on them. And what I would just say here, just to finish, again, in the interest of time, is that all of this is still a proposed rule. It is not a final rule yet. It was put out last year. There was public comment on the rule. They received over 26,000 comments, almost all of which favored banning non-compete agreements. But they haven't acted since that comment period ended last April. So the expectation is we'll hear more about this, maybe a final rule within the next 3 to 6 months. So it is still in the proposed stage technically.
And one last question before we wrap up, Jim. It feels like pressure has been building to get rid of non-compete agreements, just like what you're talking about. And so people have started to use non-solicitation agreements more. Is there any impact that you're seeing on non-solicitation agreements?
Not as of yet. And again, I think what it's going to come down to once this rule is in final shape is how that's written. There's a fairly fine line between am I competing with you more broadly or am I just soliciting? So in other words, if I leave a company and I'm in a sales function and I have a non-solicitation agreement, I go to a competitor, but my old clients start reaching out to me as opposed to me reaching out to them. And again, the proof's in the pudding there, but that is generally going to be okay. A non-solicitation would say I can't go solicit business from them for a period of time. And so far, those are still going to be allowed as long as they're drafted the right way and don't turn into something broader, which is a non-compete.
Got it. Well, Jim, thank you so much for this legal update. You're always a bearer of uplifting and good news. And do these slides be available? We're going to send them out to you, so there's more detail that you can read in here. Jim also had some slides on non-compete agreements, so feel free to read through that, but we'll get that out to you, along with the contact information for both our friends at Matrix Capital Markets Group and for Jim. So if you have any individual questions, we'd just encourage you to reach out to them, and they're happy to help answer those for you. So Spencer, Sean, Jim, thank you so much for the education that you provided here today, and hope everybody has a great day. Take care.
Thank you. Bye-bye.
Thank you very much.